Last time I spoke about using a spreadsheet of the S&P 500 to help you pick the stocks that you might like to invest in your teenager's custodial account. Today we're going to talk about a concept called diversification and how an exchange-traded fund can help with that. So you can see that if you picked one stock off this list and invested all of your money in it, that if that share price were to significantly decrease, or if even worse, the company were to go bankrupt, that you could lose most or all of your investment. If you diversify, what you're doing is trying to spread the risk of that happening over multiple stocks. So you can see that if you chose 40 of these stocks and invested equally in them, that the risk of one company going bankrupt or the share price significantly decreasing would not have as much of an effect on your total portfolio than if you were simply invested in that one stock and it had trouble. That introduces the concept of an ETF, or exchange traded fund. What is an ETF? Well, an ETF is a basket or a collection of stocks and bonds, and it's managed by a professional manager. That professional manager chooses the stocks or bonds that exist within that particular exchange-traded fund. In exchange for that, you'll pay a price for that management fee, and I'll show you how that works coming up here in just a few minutes. Some of you may have heard of mutual funds and thought, well, what's different between a mutual fund and an ETF? There are a number of differences, but just quickly, an ETF trades like a stock. So you can see the stock or the ETF share price at any given moment. A mutual fund doesn't trade like a stock. It trades at the end of the day when the stock market closes. Another important difference, especially if you're just starting out with not very much money to invest, is that many mutual funds have a minimum investment. You can see $3,000 from Vanguard. An ETF does not have a minimum investment. You just have to pay whatever the price is of that share. It could be $20 to $30, or it could be hundreds or thousands of dollars. Now, what I've done is pull up a list here of the Vanguard exchange-traded funds, and these vary. You can see that there are some purely bond exchange-traded funds, and you can see that there are equity exchange-traded funds, or stock funds. I'm going to just click on a few of these and we'll compare some of them. So we'll pull up a bond ETF. Here's just a treasury ETF. We'll pull up a mega cap growth ETF. We'll pull up a small ETF. That's what the Russell ETF is. And let's pull up an energy ETF, and a very popular one is the information technology ETF. If we were to compare these, what we'll see here is it tells us what the asset class is, stock versus bonds, and it describes for you some of the risks, or the potential risk of this particular class. So the lower the number, the lower the risk, but generally that can also mean the lower the return on your investment. Another thing it shows here is the expense ratio. I mentioned that you'll pay a fee to the fund manager. The lower the fee, oftentimes the better, or the more money that you'll be investing of your own money and not paying someone else. Now, oftentimes you get what you pay for too. So you'll have to weigh whether an expense ratio is worth it to you in order to get a higher return. But this is what you'll pay. So 0.07% of however much money you have invested in that particular ETF will go to that fund manager every year. It shows here what the last price of that particular ETF was. You can see that the lowest priced one on this particular list that I chose is the Vanguard Energy ETF. It'll also tell you what the change in price was, and then it talks about the bid and ask. That's just essentially what you'll pay and what you'll get when you go to buy or sell. Now, another thing that it will show you here is how the funds have done over the last 1, 3, 5, 10 years. And You can also come down here and you will see what the largest holdings are in each of these ETFs. So if you want to invest in information technology, you can see that Apple, Microsoft, Visa, Intel, etc. These are the top 10 of the assets. And it also shows you what the net percent is, or the percent of these assets are of the top 10. So in the information technology ETF, these 10 stocks here make up 59% of the ETF. You can see that that isn't necessarily super diversified, but definitely more diversified. If you click on the actual ETF, it will tell you the number of holdings that are within that ETF. So there are 330 stocks total, but of those, the top 10 make up 59.7%. Well, this certainly introduces the concept of diversification and ETFs, exchange-traded funds. I think that they can be very helpful, especially when you're just starting out. You rapidly diversify yourself. Another interesting thing that you'll notice here, though, is that many of these ETFs tend to duplicate. So the Mega Cap Growth ETF and the Vanguard Information Technology ETF, you can see that the top two stocks are Microsoft and Apple. You can also see that Visa is included here and here. So as you start purchasing some of these ETFs, you may find that you're duplicating a lot of your efforts. It's important to know what's available in your exchange-traded fund. Well, I hope that introduces the concept for you. If you have more questions, I hope you can get into the Vanguard website yourself. It's very helpful in purchasing ETFs, even if you're not using Vanguard as your vehicle for investing. It's very educational. Thanks a lot, and I'll talk to you next time.